going over technical analysis, support, and resistance trading. So traders, support and resistance is probably the most important part of a technical analysis when understanding key levels in the markets where price have historically been used to either buy or sell a currency at specific exchange rates. And we must remember that support and resistance levels are levels where a buyer or a seller will come into the market to buy, and a trader will come out of the market and use that as a profit target. And I will go over this in more detail. But simply put, traders, a resistance is stopping price from going higher. So when we're looking at the Great British Pound here against the Japanese yen, we can clearly see each and every time the pound has tried to go up in value against the yen past the exchange rate price of 148, 149, we have seen sellers come into the market and push price lower. So the pound has been failing to get above this key level now, going back to July of 2018. So this is quite a significant level that will need to be breached in order to continue the pound's momentum to the upside against the Japanese yen. So resistance is seen as almost a ceiling, preventing price from going higher. At a support level is seen as a level that supports my currency from falling lower in the markets. So for example, around 142, you can see we had a bounce off the market here. Buyers came in, a bounce off the market here before it broke to the downside. So that's what you consider a support level in the market. So resistance is a ceiling where sellers come in, and a support level is a floor where buyers come in and push price in the opposite direction. Now, when you want to draw your support resistance lines, traders, it's always good to go to the highest time frame so you can get a bird's eye view on the market, and you can see historically going back as far as an exchange rate chart will allow you to go back, and you can see where prices have bounced around certain specific levels that are very, very strong in the market. So traders, one thing to note, that the major levels are always around whole numbers and exchange rates. So when I say whole numbers, I'm talking about an exchange rate such as 160. So as you can see here, around 160, price going back till 2009 has been used as a resistance level. So as we can see, the market came up, it was resisted. The market came up here, it was resisted before it broke through. And then again, we could see before it came back down, there was a bit of price action around this level here. So this could be considered as a key level that we want to keep our eye on if markets come up to this exchange rate price again. So another level we can look at right now is 154 in exchange rate price, because we can clearly see when prices came up here again, this on a monthly chart, remember. So for 1, 2, 3, 4, 5 bumps, price was around 154, and it was failing to get above this level, and then it broke to the upside, and then finally price was able to get above that level. And then when it came back down to this level again, we bounced off it as a floor, we bounced off it as a floor again, we bounced off the floor again, and then we came back through it. And then when we came up to test it again, it then acted as a resistance level. So one thing to note is that support and resistance levels will flip, traders. They will go from a support level, and then once it breaks, markets will then use that as a spring to continue to trend in its current direction. So a resistance level will flip to a support once it's broken, if there is a long-term trend going in that direction. And if there's a support level that has been broken and there's a downtrend on a retest of a previous support level, that will then flip into a resistance, and investors will use that as a spring to continue the downtrend in the market. So that's why we do see price action going from a support from a resistance to a support, from a support into a resistance. It kind of flips in and out from each other. So that's just something to pay attention to be aware of when you're looking at support and resistance levels. But if you look, traders, the key levels are all around whole numbers. So again, if we look at 140 in exchange rate, look how many times this has been a floor where markets were bouncing off this key level. This goes back to 2013. This goes back to 2011 as a resistance level. This goes back to 2009 as a support level. So you can see around this exchange rate price, a lot of things are happening in the market when price comes around these levels, and that can even draw us on more exchange rate prices. So if we're looking at around if we're looking here around 117, we can see this is a support level in the market, where price has bounced off this level continuously. We're going to bounce to the upside. So this is an exchange rate price that has acted as a floor before. And then again, we can see here 135 was a lot of selling price action around this level in the market. As we can see here, resistance, and then again here, support level in the market. So traders, one thing deep though to notice is that a resistance low one is not a specific number, okay? It's more almost a range around that number. So I will show you in more detail how you draw this and how you can really use this range to when you want to get in and out of the market, which I will be showing you in a separate video. But in this video, I just want to show you how to draw these levels, how to identify these levels, because it's really important to see these in the market and know where prices are likely to get some sort of reaction. So if you are in a short position, for an example, in a zone this currency pair, and it comes down to a level which has historically seen high bounces and reversals from this level, then of course we can think to ourselves, okay, around this level, maybe from this sub position, only be taking my profit around these levels and not try to sell at these levels when we can consistently see buyers are coming in at this support level 117, for an example. So traders, draw your lines on the monthly chart. Try to have them going around whole numbers. So the whole number could be 128 or in between each 100 pip movement and price. So you could put it 128, 500. So between the whole numbers, you can have exchange rate prices. So look, 136, 500 is pretty much where this support level falls. I think about 140, 114 exchange rate. We've got 142, 500. So you get an idea of what I'm trying to say. And if you go down to the weekly chart, you can then match these up to weekly levels. And if you see the same price action being very more clear on a weekly chart, then you could draw some in. Some levels in a weekly chart are more you can identify them more than a monthly level. So do your monthly charts first, draw your lines in so you know the levels that have been resistance and support levels, and then go to the weekly, and you might find other levels that you couldn't really spot in the monthly chart. And then you could draw these levels in as well, and that will become more clearer to you in the market. An example is here. You can see how around this exchange rate price, this has been a floor. You can see that, traders, right? Ceiling, but then it broke through, came back down, and there was a floor. But on the monthly chart, this level 127.500, as you can clearly see, it's always around the 100 levels. And the reason for this, traders, is really to understand. If you're to buy a car, someone asks you, how much did you pay for your car? And you paid £20,000. So the car was, you pay, say, £18,935. You just round it off to say, I paid 20 grand for the car. Now, when investors are placing their orders around key levels, they'd rather put them around whole numbers because they have an idea around that whole numbers where a lot of orders are likely to be placed. So it's basically trying to put the ball in your court and try to get it just around a good area. You can have a big enough stop loss around this area just to understand around this level, there will be a lot of orders based around this whole number instead of someone saying, I'm going to put a stop my buy order around 127.468. For an example, you just put it at 4. You just put it at the whole number of that you're looking at. So that and explains why exchange rate prices are around whole numbers. So 127.500. Go to the monthly. It's left clear on the monthly than it was on the weekly. Oh, actually, in this case, it was. I just missed it. So I can't. Sorry. I just missed this one. But yeah. So you can understand, trader, that on a weekly chart, you will see specific levels on the weekly that you probably won't see on the monthly. That was a bit of a bad example, but you will see them in the market. So just draw your lines in on the weekly. Now, of course, remember, when you're looking at levels going higher, so we look at an uptrend. When there's an uptrend in the market, we have green candles. So, of course, I always put support levels that are below price as a green candle because that's when we can expect buyers to come in. And I put resistance levels above price as red. I color them red because, of course, sellers come in, and then we have red candles in the market. You can do that if you want to. You don't have to, but that's just something I prefer to do personally in the market. Now, then what time frame you trade on, but I trade on daily charts. So I draw my lines in, and then I know where my support and resistance levels are. And for an example, traders, as you can see, around 148, 149 is where price gets rejected. And this is because this is a zone. It's not a specific level. It's around this level that orders start to come in. You can see it's around 148, 149, and price goes into this zone and it comes right back out. So this is a 100 pip zone for this specific exchange rate for the pound against the Japanese yen. So this is something to understand. Exchange rates, support and resistance levels are not specific prices. They're more zones in the market where you'll find markets coming in, and then you'll see buyers or sellers coming at that exchange rate price around that price. And there's usually like a 100 pip zone, could be 150 pip zone. You'll even see sometimes prices go right into the zone, come out, and then you'll see them come straight back down. So this is something to understand, something to pay close attention to, that when you're drawing support resistance, traders, just keep your eye on the levels, and then understand the level is not an exact number. So don't put your order right at the beginning of a level and then only have a 20 pip stop loss, because it's likely you're going to get hit, because zones are usually around 100 pips or so. So I hope that makes sense. I hope that explains support and resistance to you, which is one of the key things in technical analysis you need to know, need to have a little understanding for. And more importantly, traders, we must remember that exchange rate prices have a direct impact on a country's balance of payments. So when you look at the understanding economic data video in this members area, you won't recall that a balance of payments is very important for an economy. So if the exchange rate price of a currency is too high, for an example, this might make the exports of that economy, from that economy, too expensive for foreign consumers. So if the value of the pound was to go too high against the Japanese yen, this could mean that Japanese consumers find certain goods in the United Kingdom too expensive, right? And this could probably put, for an example, the car industry out of business in terms of selling cars to Japan, because Japanese consumers may say, well, buying cars from the United Kingdom is too expensive, so I'll just go somewhere else and I'll buy cars. And then the UK government, right? This is where direct intervention comes in. You might get the governments of central banks purposefully selling their own currency against the Japanese yen to make sure it doesn't go any higher in the exchange rate, because it can damage complete industries if it goes any higher. Which is why you have to kind of look at exchange rate prices at the levels that governments of central banks, key levels that they'll intervene, and they'll manipulate the value of their currency to make sure that they keep their export prices at a competitive price on the market. And if a currency goes too high in value, this may cause, as I said, exports too expensive. Then this can mean a reduction in money coming into the economy from export sales. There's a reduction in economic growth. Then that can affect industries. Employment might start to go down because businesses let go of their workers because they're not making as much money from export sales. And of course, we know from the previous video I did mention that coincident economic indicators like strong employment, strong GDP growth is what the central bank and government is committed. It has a mandate to make sure and they achieve stronger levels in these economic indicators. So we must understand that, and understand that key levels in exchange rates are there for a reason. And it could be that once a currency's value goes above or below a certain price, the central bank has to intervene and weaken the value of their currency, or even strengthen the value of their currency to make sure that they control, remember, their coincident indicators. So for an example, in the UK, say the pound got too weak, and I'll give you a perfect example of this. After the Brexit vote in 2016, so as you can clearly see in 2016, the pound absolutely plummeted by around 20% in the markets, and this made imports into the economy very expensive because the pound's purchasing power had devalued by so much. So businesses inside the UK found it really expensive to import goods from abroad, but they needed to sell for within their business, and then they in turn had to raise their prices on the shop floor to cover their costs, and this made inflation in the UK skyrocket above 3%. And I'll give you a perfect example. So go to tradingeconomics.com. Again, really good website. Let's go to the UK. Let's have a look at this for an example. Let's go to the United Kingdom. Let's do our analysis for inflation at 1.9%. Let's go and date it back to 2015. So let's go, sorry, 2016. Let's go, for example, to the 1st of January up until present day. Now look at this, traders. In 2016, let me see if I can change this to a column chart. Now we can see in 2016, inflation was low, okay? Then the pound absolutely plummeted in value. And then, as I said, businesses were forced to raise prices in an attempt to keep their profit margins strong, because they were losing money because they had to pay so much for their imports. And this caused inflation in the United Kingdom to rocket to nearly 3%. Now remember, the central bank's mandate is to keep inflation at 2%. So inflation was getting too high, and then subsequently, this is where markets speculate the central bank came in to buy the pound immediately, and then they was raising interest rates as well to make the value of the pound rise to make sure that inflation came down. So they successfully achieved their mandate of 2% inflation, and they have managed to do that. Inflation has now gone down to 2% because the pound's value has risen from the lows it was at, and now imports are less expensive and businesses can bring down their costs, and this causes inflation to fall in the market. So that's a really, really good example, traders, to see why exchange rate prices, resistance levels, support levels are actually probably levels in the market that central banks and governments can come in and intervene, manipulate the value of their currency to make sure that the balance of payments is supporting growth in the economy. Because if the currency value goes too high, this can make their exports too expensive, or if it goes too low, it can make imports too expensive, and that can have a damaging effect on them successfully achieving their coincident economic indicators from hitting their targets. Hope that makes sense, traders. That's support and resistance. And probably follow on and watch the following video on entry and exit strategies using support and resistance, and that will give you a technical basis on placing trades in the market. Thank you for watching.